Welcome to The Explainer. Today, we're unpacking a story that has absolutely captivated the financial and crypto worlds. We're talking about a massive corporate philosophy that just underwent a dramatic, highly unexpected, and fundamentally structural shift. You see, for years, one specific company has literally defined the ultimate corporate playbook for holding digital assets. But suddenly, the rules of that game have been completely rewritten.
Okay, let's dive into this. 847,363. That is the staggering number of Bitcoins held in the Treasury of Strategy Incorporated, based on our source data. It's a massive, totally market-defining number that makes them the single largest corporate holder of the asset on the entire planet. But, as you can probably guess, holding that much crypto comes with incredible pressure when the market decides to turn. Here's how we're going to untangle all this dense financial drama today. First up, the ultimate Bitcoin proxy. Second, we'll look at how the flywheel hits a wall. Third, the 5-part capital plan. Fourth, breaking the never sell pledge. And finally, we'll wrap up with the bulls versus the bears.
Section 1. The ultimate Bitcoin proxy.
Now, to really grasp the magnitude of what just happened, we have to understand the foundational premise of strategy under its leadership. For years, under the direction of Saylor, the old strategy was built on this famous ironclad philosophy. It was all about one-way capital issuance to buy Bitcoin, combined with a strict pledge to never ever sell it. It was basically a one-way street of perpetual accumulation. But look at the new strategy. It's a completely different beast. They've suddenly transitioned into active two-way capital management, and that includes share repurchases and, shockingly, strategic asset sales to survive market volatility. So, how did we get from point A to point B?
Section 2. The flywheel hits a wall. Well, the catalyst for this massive shift was a structural crisis triggered by the broader crypto market. Back in late June 2026, Bitcoin plummeted below that critical $60,000 threshold, and this price drop had a devastating impact on a crucial metric for the company, known as MNAV, that stands for multiple on net asset value. Simply put, this measures the premium at which Strategy stock trades relative to the actual spot market value of the Bitcoin it holds. Historically, a high MNAV, like above 2.0x, allowed Strategy to act like a magical flywheel. They could issue new shares at a massive premium and then use those dollars to buy even more Bitcoin. This meant every single new share issued actually increased the amount of Bitcoin backing each individual share. It was a brilliant, accretive, perpetual accumulation machine.
But on June 25, 2026, that machine broke. The MNAV collapsed to a razor-thin 1.03x. The institutional equity premium just completely evaporated. And when MNAV is near par like this, issuing new stock provides absolutely no structural leverage. Any further equity issuance would just dilute current shareholders without actually increasing that baseline Bitcoin per share metric. So their accretive buying power ground to an absolute halt.
So, the crucial point here is the domino effect this caused. As Bitcoin slid and the MNAV compressed, the company's yield-generating preferred stock, ticker STRC, crashed 8.2% to $74.25. That's a severe 26% discount to its $100 par value. And because the company issues this stock into the market above $100, this subpar trading effectively shut down their accumulation channel. They were caught in a liquidity trap, totally freezing their ability to raise fresh, low-cost capital. And, as you might expect, the internet quickly began swirling with rumors of an impending corporate death spiral.
Section 3. The 5-part capital plan.
Faced with a frozen flywheel and plummeting preferred stock, management had to act decisively to quell the market panic. So they introduced the Digital Credit Capital Framework. Think of it as a 5-part survival toolkit that completely rewrites the company's financial rules. First, a strict USD reserve policy. Second, bumping the STRC dividend up to 12%. Third and fourth, massive $1 billion buyback authorizations for both digital credit securities and common stock. And fifth, the most radical step of all, a formal Bitcoin monetization program. Let's break down why this is so effective.
Now, what's really interesting about this slide is the sheer scale of the safety net they've built. By establishing a $2.55 billion reserve against $1.76 billion in annual obligations, Strategy essentially bought themselves 17.4 months of operational runway. This cash buffer is ring-fenced, meaning it can only be used to pay preferred dividends and interest on debt. This directly debunks those death spiral rumors, because it proves they can just sit perfectly still for nearly a year and a half without facing forced liquidations of their core treasury. Alongside that cash reserve, they raised the dividend yield on that STRC preferred stock to 12%. The explicit corporate objective here is to restore market confidence
and drive the trading price of STRC back up toward its $99 to $100 target band. However, they also made it clear they aren't just going to keep raising the coupon rates solely to chase the discount anymore. They now have other tools in the shed.
Section 4. Breaking the Never Sell Pledge.
Okay, so the most shocking element of this new framework is the official end of the era of permanent, unyielding accumulation. Actually, the warning sign started a bit earlier. A historical 8K filing revealed that in late May of 2026, Strategy sold 32 bitcoins for about $2.5 million. It was literally their first sale since 2022. While they did this to demonstrate they could support dividends by liquidating assets, the market interpreted it as a glaring sign of cash flow strain. A company completely defined by the narrative of never selling had officially broken its strict pledge. And now, under the new framework, this isn't just a quick emergency measure. It's an institutionalized policy.
And this brilliantly illustrates the new dynamic. The board authorized a Bitcoin liquidation plan to raise up to $1.25 billion. But looking at the reality of that authorization, a $1.25 billion potential sale, while a massive number to you and me, is just a tiny sliver, a rounding error, really, compared to their total treasury of over 847,000 Bitcoins. This perspective is absolutely vital. It shows that while they can sell, they definitely aren't aggressively dumping their core holdings. They're just utilizing Bitcoin as a fluid, flexible capital management tool.
Section 5. Bulls versus the Bears.
So how has the financial world reacted to this dramatic pivot? Well, the market reaction to this financial engineering is intensely polarized, and we're going to look objectively at both sides here. Let's start with the bulls. Mark Palmer, an analyst at Benchmark Equity Research, views this new framework as a massive win. He points out that the company is no longer stuck in a one-way street. By repurchasing shares at a discount and effectively pausing issuance when the stock doesn't trade at a premium, management is actively defending the capital structure. Benchmark remains incredibly optimistic, maintaining a buy rating with a lofty $570 price target for the stock.
But on the other side of the aisle, the bearish whiplash is pretty severe. Economist and longtime crypto skeptic Peter Schiff takes a remarkably dark view. Pointing to the times when the company sat on unrealized losses due to Bitcoin price dips, Schiff predicts this entire strategy will unravel. He even goes as far as comparing it to JP Morgan's disastrous London whale fiasco, suggesting that eventually this will go down as the biggest losing trade in history. The skeptics fundamentally doubt the sustainability of using preferred stock financing to buy highly volatile cryptocurrencies.
Which leaves us with a profound question to end this explainer. Does corporate financial engineering, leveraging debt, issuing preferred stock, managing dividends, and timing buybacks, actually create sustainable long-term value? Or does true value in the crypto space only come from the underlying utility and the simple, steadfast act of holding the asset? Strategy has bought themselves 17 months to prove that their new two-way playbook actually works. It's a fascinating evolution of corporate finance, and you can bet the entire market is watching to see what happens next. Thank you for joining me for this explainer.